And we value your feedback and request that you please complete our survey, which is also on the console. We plan to cover quite a bit of information during today's class. If at any point in time you are interested in scheduling a one on one meeting with Morgan Stanley Investment Management, please click the button to confirm in the meeting request box on your screen. Before we get started, we'd very much like to get your input on a couple of polling questions. The first polling question should appear on the screen for you now, and that question is: have you previously considered how tax forward alternatives can benefit investors with the following financial planning outcomes in mind? And select all that apply: diversifying concentration risk, tax preferential income, income diversification, and or estate planning, generational wealth transfer. Again, the first question is: have you previously considered how tax forward alternatives can benefit investors with the following financial planning outcomes in mind? And you can select all the answers that apply by clicking directly on the screen. Great. The next polling question should appear on the screen for you now. The second question is: which of the following tax forward alternative strategies are you most interested in learning about? And you can select all that apply. Your answer choices are concentrated wealth strategies, tax managed private fund strategies, tax advantage income strategies, including REITs, and or insurance dedicated solutions. Again, the question is: which of the following tax forward alternative strategies are you most interested in learning more about? And you can select all that apply. Thank you. The third polling question is: how comfortable are your clients with investing in insurance or annuity products, such as private placement life insurance, PPLI, or private placement variable annuities, PPVA, as a way to shelter private assets from taxes? Your answer choices to choose from are: A, my clients would mostly be comfortable with such products; B, they could become interested, but they would need to understand them better; or C, my clients would be skeptical of such products. Again, this polling question is: how comfortable are your clients with investing in insurance or annuity products such as private placement life insurance or private placement variable annuities as a way to shelter private assets from taxes? This brings us to our final and fourth polling question. And the question is: what roles do you like to have alternative assets play in your clients' portfolios? And please select all the answer choices that apply. Your choices to choose from are return enhancement, portfolio diversification, tax efficiency or reduction, and or broadening of the investment universe. Again, what roles would you want alternative assets to play in your clients' portfolios? And you can select all that apply: return enhancement, portfolio diversification, tax efficiency or reduction, and or broadening of the investment universe. As a reminder, we welcome and encourage your questions, and you can type your questions into the Q&A box. We'll do our best to get to as many questions as possible. If your question is not answered, we will follow up with you directly. Thank you again, and now let's get started.
Hello, and welcome to Course 5 of Morgan Stanley's Alternatives Investing Center. I'm Frank Familetti, Managing Director at Morgan Stanley Investment Management and Head of Intermediary Distribution for Alternatives. In today's course, we will explore a tax-forward approach to alternatives. Our goal is to examine how investors and advisors can utilize alternatives, strategies, and vehicles to optimize after-tax outcomes in ways that align with their investment goals. It's important to note that the suitability of these strategies will depend on what is appropriate for each individual investor. investors should consult a tax professional to understand the potential tax implications and to determine the best approach for their specific financial situation. As part of this course, we will discuss several innovations. In part one, we will explore concentrated wealth strategies, which aim to tax efficiently diversify concentrated positions. In part two, we will discuss tax managed private fund strategies, which seek to generate tax alpha from a portfolio of private funds. Part three addresses tax advantaged income strategies, specifically REITs, which can potentially improve after tax outcomes. And finally, in part four, we'll examine insurance dedicated strategies, which may help clients achieve tax advantaged growth. This course is specifically designed for financial advisors and taxable investors who are currently investing in alternatives or are planning to do so. This includes high net worth individuals who have substantial capital allocated to alternative assets and may benefit from strategies aimed at minimizing their tax liabilities and enhancing their after tax returns. Family offices who manage wealth across generations and may seek to leverage tax strategies to optimize estate planning, facilitate the transfer of wealth, and reduce their overall tax burdens. Sophisticated investors who have a deep understanding of alternative assets and who actively manage their portfolios to achieve optimal tax outcomes. And finally, business owners, including entrepreneurs who incorporate alternative investments into their broader investment strategies and may benefit from tax planning that aligns their business goals and personal finance goals. Each of these innovations we discussed today is designed to enhance the tax efficiency of alternative portfolios and can be customized to meet a wide array of investment goals. Many tax strategies that apply to private offerings are subject to different sets of regulations than public, commingled vehicles such as common stocks. In 1982, the Securities and Exchange Commission reinforced restrictions on private offerings through Regulation D, establishing the criteria for investor participation in such investments. To qualify, accredited investors must have a net worth of at least $1 million, excluding their primary residence, or have an annual income of more than $200,000 individually or more than $300,000 in yearly family income. Additionally, the Investment Company Act of 1940 introduced the concept of qualified purchasers, another category of investors eligible to invest in private funds and partnerships. Qualified purchasers must show a net worth exceeding $5 million, excluding their primary residence. Private funds and partnerships also have distinct tax structures. For investors in private partnerships, such as traditional private equity drawdown funds, taxable income is reported to investors on a Schedule K-1 tax form. A K-1 is the main tax document utilized by private partnerships to report items of income, deductions, gains, losses, and credits to the IRS on behalf of the partnership shareholders, partners, or beneficiaries. Recipients of K-1s must report their share of the partnership's income, credits, deductions, gains, and losses on their personal tax returns. For most trusts and estates, beneficiaries are issued K-1s, which report their share of taxable income that is allocated from that trust or estate. For investors in evergreen vehicles, a fund structure that is gaining popularity, taxable income is typically reported on a Form 1099. These forms report income other than salaries and wages and offer a more streamlined tax reporting process as compared to a K-1. This can significantly reduce the administrative burden for alternative investors. There are other tax reporting considerations. Many of these investments involve pass-through entities, such as partnerships or limited liability companies, LLCs. Investors in these entities receive K-1s, which detail their share of income, deductions, and credits for tax reporting purposes. When reporting capital gains allocated to investors from various fund structures, investors should be mindful of the holding period. Long-term capital gains, which apply to assets held for more than a year, are generally taxed at a lower rate than short-term gains. Additionally, some private placements may generate tax benefits, such as tax credits or deductions. Investments in renewable energy projects, for example, may provide special tax incentives. Lastly, one crucial consideration for many investors is inheritance and gift taxes, particularly the limits on tax-free transfers allowed by the IRS. As of 2025, The gift tax exclusion permits individuals to give up to $19,000 per recipient per year without incurring a gift liability. There is also a lifetime limit to the gift and estate tax exemption. Starting in 2026, individuals can give up to $15 million over their lifetimes or leave up to that amount to heirs without incurring estate or gift taxes. Once that limit is reached, federal estate taxes come into play. In 2025, these taxes ranged from 18% and 40%. Keep in mind that many states also levy their own estate taxes, which can further impact total tax liability. And with that background, we are now ready to explore our first tax forward alternative strategy. For this, I turn things over to my colleague, Brian Smith, who will cover concentrated wealth strategies.
Thank you, Frank. Holding a concentrated position in a single stock or a handful of stocks can lead to excess risk in a client's portfolio. Concentration in a single company, industry, or sector can expose investors to additional volatility and underperformance that may impact their ability to achieve their financial goals. A concentrated position is defined as one that makes up a disproportionate percentage of an investor's overall portfolio. Depending on the investor's risk tolerance and conviction in the security, we typically say that an allocation is concentrated if it exceeds 10 to 20% of that investor's net worth. Broad diversification is essential to mitigate these risks and build a more resilient asset allocation. Concentrations can come from a number of sources. Single stock concentrations might stem from incentive compensation, inheritance, or a smart trade. More common are concentrations within an asset class. This is when a particular area of the market substantially outperforms. Left unchecked, the investor may find themselves exposed to more risk than they realize. In both single stock concentration and portfolio concentration, inaction may be rooted in emotional or cognitive biases. Our role is to help investors understand the tools available to take these challenges head on. One of the most frequent biases we see from investors is fairly logical. Many clients have an aversion to paying taxes. That's not surprising when you look at the actual cost of selling an asset that has appreciated greatly. Take, for example, an investor in California who is in the highest income tax bracket. This investor has a concentrated exposure with a market value of $5 million and a cost basis of $1 million. Assuming long-term capital gains tax treatment, the investor's combined federal and state tax rate would be 37.1%. A sale of this asset would realize $4 million in capital gains, resulting in an out-of-pocket cost of $1,484,000. That would only leave the investor with $3,516,000 in after-tax proceeds. Assuming the goal was diversification, the investor would be able to put that $3,516,000 back to work in a diversified investment. But they would have a 42% hurdle rate, meaning that that investment would need to grow by 42% to get the investor back to their starting value of $5 million. Let's look at what that could mean over a long-term investment horizon. Please note that the following example is gross of fees. That $5 million value, if left intact, could grow to over $9.8 million over a 10-year time frame, assuming a 7% annual return. Comparatively, if we look at after-tax proceeds in 3 different state tax systems, the investor significantly stunts their compounding potential. An investor in Florida would only see their investment grow to $7.96 million. The investor in California would only realize $6.92 million. And the investor in New York City, only $6.8 million. Tax deferral can be an incredibly powerful tool for long-term wealth accumulation. When investors defer taxes on capital gains, Their investments continue to grow without the drag of immediate tax payments. This compounding effect can significantly enhance long term portfolio value, allowing investors to keep more of their returns working for them. Exchange funds are specialized private investment vehicles designed to help investors transfer assets from their portfolio without triggering immediate capital gains taxes. By contributing appreciated assets to these funds, investors receive ownership units representing a slice of a commingled investment, typically constructed to provide exposure in line with a benchmark. This mechanism allows investors to swap single stock risk or to transition a portfolio to a broad market exposure, and do this while deferring the recognition of capital gains tax. Generally, no gain or loss is recognized by investors contributing securities to an exchange fund, as long as the exchange qualifies under the applicable rules that are outlined in Sections 721 and 351 of the Internal Revenue Code. Section 721 of the Code stipulates the general rule that no gain is recognized to a partnership or to any of its partners for contributions of property that are exchanged for interest in the partnership. However, this same section of the code provides a distinction that if a partnership is treated as an investment company, it does not qualify for that non recognition. Each exchange fund operates under a provision of Section 351 of the code that would allow the partnership to not be treated as an investment company. The three strategies we will review today are traditional exchange funds, which target qualifying assets, diversified exchange funds that involve a basket of appreciated stocks, and target stock funds that involve single stock positions partnered with tax loss harvesting. Traditional exchange funds, which have been around since the 1960s, involve the use of qualifying assets. These funds let an investor transfer a concentrated stock position for a slice of a diversified portfolio without selling their shares or triggering capital gains tax. The investor uses their stock position as currency to buy into the fund along with other investors and receive ownership units that represent their share of the larger pooled portfolio. The level of diversification achieved depends on the size and scale of the existing pool of assets. When considering an exchange fund, it is important for investors to understand the existing asset base that their contribution will be joining. Most exchange funds operate as limited partnerships. When investors contribute their stock, they become a limited partner in the fund, while a general partner manages the portfolio. Think of this general partner as the gatekeeper to the portfolio, ensuring that the allocation does not become overweight in a particular stock, industry, or sector. A general partner makes sure that the equity exposure continues to look and feel like the target benchmark over time. As previously discussed, traditional exchange funds qualify for tax deferred treatment through the use of a qualifying asset. Therefore, most traditional exchange funds will have exposure to a real estate portfolio, in addition to the pooled equity. Section 351 of the Code stipulates that a transfer of property to a partnership will be considered a transfer to an investment company if more than 80% of the value of the partnership's assets are stocks and securities. An exchange fund seeks to ensure that upon the transfer of securities to the fund at any closing, a minimum of 20% of the fund's assets will be qualifying assets, typically real estate. The real estate is purchased with loans that use the contributed securities as collateral. If structured appropriately, the cash flow from this real estate can be used to service the debt. Another strategy involves diversified exchange funds, which may be used for investors who wish to transfer not a single stock, but an appreciated basket of stocks for a slice of a diversified portfolio without the need to sell shares or trigger capital gains tax. As with traditional exchange funds, The fund's manager will act as a gatekeeper and analyze any proposed contributions to the fund to ensure that the underlying investments maintain alignment with a target exposure. These funds utilize a different exemption to Section 351 as applied to partnerships. This exemption states that a transfer of property to a partnership will not be considered a transfer to an investment company if each contribution transfers a diversified portfolio of stocks and securities. Their definition of diversification is probably not what you or I would consider diversified. The test is simply that no single stock can be more than 25% of the total contribution, and no five stocks in aggregate can be more than 50% of the total contribution. In theory, all of the stocks in the basket could be from the same sector or industry. But as long as they pass this low bar definition of a diversified basket, they meet the requirement. There are a few common misconceptions about exchange funds that are important to debunk. The first, which I hear all the time, is that exchange funds have a 7-year lockup. There is no 7-year lockup on an exchange fund. Most established exchange funds offer daily liquidity. The second misconception is that investors only benefit from diversification after 7 years. Again, that's a misunderstanding of the 7-year rule. Investors in established exchange funds benefit from immediate diversification. From the moment they participate, they own the NAV of the fund, for better or for worse. The 7-year rule behind these misconceptions is simply a distinction for how the funds need to meet redemptions so that they do not trigger the recognition of capital gains to the redeeming investor. For any redemption by a shareholder within the first 7 years, the fund must return shares of the originally contributed stock to that investor. The redemption will be based on the prevailing NAV of the fund. If the fund's shares are worth less than the contributed stock, the shareholder would receive the lesser value. If the fund's shares are worth more than the contributed stock, the shareholder would be made whole by receiving the originally contributed shares in addition to a filler stock to make up the difference. After 7 years, redemptions are typically met with a basket of stocks. Now, most redemptions from an exchange fund are typically made for one of two reasons. One, the investor is in need of liquidity. Or two, the investor has passed away and their heirs have received a step up in cost basis in their exchange fund investment. In either case, the assets redeemed from the fund will be sold. This means that in most cases, the person making the redemption does not care if they're getting back original shares or a basket of other stocks. The moment the shares arrive back in their brokerage account, they plan on pushing the sell button. Similar to these other structures, target stock funds are not technically exchange funds, but offer a very similar value proposition for investors with concentrated stock positions. These funds let an investor contribute an appreciated stock position in exchange for ownership in a portfolio without selling the shares or triggering capital gains tax. These funds utilize a different exemption to Section 351 as applied to partnerships. A transfer of property to a partnership will not be considered a transfer to an investment company if the transfer does not result directly or indirectly in diversification of the transferor's assets. By only accepting contributions of a single ticker, at the time of the closing, a contributing shareholder generally does not further diversify their interest in the stock. These funds will only offer a single closing or opportunity to participate. After the fund is established and shares of the target stock have been contributed, a loan is taken against the target stock position, typically with the intention of beginning to build a long-short investment strategy. The long-short exposure provides an opportunity for pre-tax outperformance while also acting as a tax loss harvesting engine. This tax loss harvesting allows for the target stock to be sold systematically over time, with adequate losses to offset the gains realized from the disposition. There are two different flavors of target stock funds: hedged and unhedged. Hedge solutions utilize derivatives to minimize or eliminate the investor's market exposure to the target stock during the staged divestment. Unhedged is simply a staged diversification mandate. This approach offers the investor a glide path to diversify tax efficiently out of the concentrated exposure over a set period of time. Investors need to consider carefully their willingness to maintain significant exposure to the concentrated stock during that unwinding period. All three diversification strategies are intended for a long-term holding period, meaning they are best suited for assets that a client is unlikely to need in the immediate future. We frequently see investors carving off a portion of their concentrated assets and using exchange funds for their retirement dollars, their rainy day funds, or very frequently for their estate planning assets. Since these investment solutions will not interfere with an estate plan, they can easily be parked in a revocable trust. If you need access, you have them on hand. If you pass away, they are easily transferred to the next generation with a step up in basis, assuming that the estate is eligible. Now we will continue to the next section of today's course on tax managed private fund strategies. In the previous chapter, we reviewed how an investor may be able to benefit from an in-kind contribution to a private fund. By avoiding the sale of an existing asset, the investor defers the recognition of capital gains and thus benefits from compounding future growth on the dollars that were not spent on their tax bill. The application of these solutions is intended to mitigate the tax liability associated with creating a taxable event. What if the investor does not have the ability to control the taxable event? What if they were selling a business or liquidating a real estate portfolio? Or potentially, they own an asset that distributes large capital gains each year. Another mechanism to defer the out-of-pocket cost of tax is to offset them. This is commonly accomplished by tax loss harvesting. This involves selling assets that have fallen below their cost basis and identifying a risk equivalent replacement security. By capturing a loss, the investor now has the ability to offset a capital gain somewhere else. The improvement in after-tax returns through tax loss harvesting is referred to as tax alpha. We have an on-demand course available in the Tax Forward Investing Center if you'd like to dive deeper into the fundamentals behind how investors can use capital losses to offset capital gains. The key takeaway is that taxes can either erode portfolio returns or they can be managed and can be additive over time. Recently, we've seen significant interest in a tax loss harvesting strategy called long-short extension investing. The concept is to use margin to increase the gross market value of the investor's portfolio, to include both a long extension and a short extension. Let's look at an example. For a long-short private fund, a manager will take cash contributions and invest them into a base portfolio. They will borrow against that base portfolio and invest more dollars into the market. They'll simultaneously invest an equal dollar amount in short holdings, which represents a bet against the market. As you see in the example on screen, this is a representation of a 200-100 mandate, which means that for every $100 invested, the investor is getting $300 of gross market exposure, $200 in long equity holdings, and $100 in short equity holdings. Executed properly, this mandate can be designed to counter the added risks of leverage, provide the potential for pre-tax outperformance, and generate additional tax losses. The increase in expectations for tax loss harvesting stems from a few factors. First, by incorporating leverage, there are more dollars at work. The investment portfolio is significantly larger than the net investment amount. This leads to more opportunities to sell holdings that fall below their cost basis. Second, by incorporating short holdings, an investor has made a bet against the market with a portion of their assets. Markets tend to appreciate more often than they decline, meaning the short book has a higher probability of creating ongoing tax loss harvesting opportunities. Third, as the investment ages and hopefully appreciates, the short side of the portfolio will be turned over more consistently. This establishes new layers of cost basis and fresh opportunities for tax loss harvesting for longer periods than a long only investment mandate. A long short investment can be constructed as a separately managed account or built inside a private fund wrapper. We've already discussed how this type of long short investment can be used to unwind a concentrated stock position in a target stock private fund. In this application, the investor is looking for capital losses to pass through to them on their tax form to be used elsewhere in their portfolio. There are different flavors of these private fund vehicles. Some are commingled funds with multiple investors. Others are referred to as a fund of one, where there is a single external investor in the LLC or partnership. There are a number of important considerations when reviewing the different flavors of long short investment mandates. The first is minimums. Commingled private funds will offer the lowest minimums and the easiest accessibility. This is because custody and lending are managed at the fund level. Separately managed accounts and fund of one structures will typically have higher minimums and more operational considerations. The next consideration is customization. SMAs and fund of one structures offer investors more flexibility. A commingled fund is take it or leave it. Another consideration is tax reporting and tax monitoring. SMAs report taxable income through a 1099, while most private funds will report through a Schedule K-1. Commingled private funds will typically be managed around constructive sale and wash sale considerations, while other vehicles likely will not. Some other tax considerations. SMAs and some specially designed private funds will offer an unlimited pass-through of losses, while commingled funds will generally limit the use of pass-through losses to the partner's cost basis of the investment and the partner's at-risk limit. The last consideration I'll touch on briefly is estate planning. Investors in private funds are typically eligible for a step-up in basis on their investment in the fund's NAV on the date that the investor passes away. SMAs will have slightly more complexity. The investor can only step up their cost basis in the long positions, but not in the short holdings. So as you can see, there are a lot of considerations when choosing how to implement long-short exposure for a client. Every investor will have unique circumstances that may make one avenue more appealing or appropriate than another. We're now going to discuss the tax benefits of real estate investment trusts with my colleague, Douglas Armour. Doug, over to you.
Thank you, Brian. Real estate investment trusts, or REITs, are designed to facilitate broad-based fractional ownership of real estate with the benefits of professional management, diversification, and liquidity that large-scale investment companies can provide without diminishing the strong tax benefits that are inherent in direct real estate ownership. Prior to REITs, real estate investment was mostly accessible to institutions and specialist individual investors because of how capital intensive and management intensive real estate ownership is. But through the REIT structure, individual investors can gain passive exposure to diversified portfolios of institutional quality real estate that they would not be able to access or manage themselves. In addition, as passive investment vehicles, REITs are designed to pass through the tax benefits and cash flows of the real estate to shareholders. REITs are required to distribute at least 90% of their taxable income, and for doing so, they receive a dividends paid deduction that reduces their corporate level tax liability, which effectively means that they are not taxed at the corporate level. This is an important distinction between REITs and other corporations that pay dividends yet are generally taxed at the corporate level. This creates a double taxation effect where after tax corporate income is distributed and is then made taxable again for the end recipient. In addition to tax benefits at the REIT level, there are two shareholder level tax concepts applicable to REIT distributions that result in tax advantaged income for shareholders. The first of these is the Section 199A Qualified Business Income or QBI deduction, which allows individual investors to deduct 20% of their qualified REIT dividend income and was initially introduced with the Tax Cuts and Jobs Act of 2017. This is the same 20% rate reduction that other passive income streams, typically partnerships, also receive, and it effectively lowers the top federal income tax rate on those dividends from 37% to 29.6%. However, unlike the reduction for other passive income streams, there are no limitations or income basis phase-outs for the QBI deduction for REITs. Every shareholder receives this regardless of whether they itemize deductions or not. Another way to think about this deduction is that for every dollar of qualified REIT income an individual receives, they will pay tax on only 80 cents of that. This deduction was scheduled to sunset at the end of 2025, but it was made permanent in the One Big Beautiful Bill that was signed in July 2025. It's worth noting that the QBI rate reduction only applies to ordinary income dividends, and that any capital gains dividends would be taxed at the shareholder's normal capital gains rate, typically 20%. The second tax concept applicable to REIT dividends is return of capital, or ROC. ROC distributions are not taxed as they are not considered income. In practice, in most property REITs, dividends are treated as ROC. Because property REITs own large portfolios of real assets, they generate significant non-cash depreciation deductions that reduce their taxable income, resulting in the potential for ROC distributions. Depreciation, in terms of taxable income, is the concept that the cost of a real asset may be deducted over time to reflect the decrease in its remaining effective useful life, even if the asset's true economic value is not declining. For real estate investments, the deductible amount is a function of how much value is allocated to the physical building, improvements, personal property, and underlying land, which is the only allocation that is not depreciable. So let's bring depreciation back into context regarding tax advantage distributions. Due to these non-cash deductions, a REIT's taxable income is very likely to be materially lower than the cash flow it generates. When a REIT distributes income to its shareholders that is greater than its taxable income, which is often the case, those distributions are classified as return of capital, and they are not taxable for the recipient. Although these investments are depreciating in terms of taxable income, the real estate is often appreciating in terms of its true economic value, especially when it comes to investments in institutional quality real estate with strong intrinsic value. When this is the case, investors are realizing economic value through tax advantage distributions as well as capital appreciation. On the other hand, this is often not the case for smaller investments or melting ice cube investments, such as real estate that is over-rented to justify an above-market purchase price. Such real estate is often depreciating in its true economic value at the same pace or faster than the depreciation schedule itself. With these investments, there is no capital appreciation at all, and the value realized is limited to the cash flow. The impact of ROC and the 20% QBI deduction significantly improve the tax efficiency of REIT distributions. In terms of the effective federal tax rate for distributions with an 80% return of capital, the 37% standard tax rate is reduced to less than 10%. Or, thinking about them in terms of taxable equivalent yield, TEY, a 5% REIT distribution equates to a TEY of 7.5%. In other words, a 7.5% corporate bond distribution yields the same after-tax return as a 5% REIT distribution with 80% ROC. That being said, ROC distributions do reduce an investor's tax basis in their shares, which raises the potential for capital gains taxes on a sale of those shares. That is why ROC distributions are often considered a valuable tax deferral and a shift from ordinary income tax rates to lower capital gains tax rates. Investors do control the timing of this tax deferral and can choose to sell their shares whenever they see fit. Some investors may want to delay selling their shares in case they incur capital losses from other investments, which would offset their gains and reduce the amount of tax owed. An investor could also decide to hold their shares for the very long term and take advantage of the fair market value basis step up that REIT shares, like other securities and real estate, receive when inherited. In this case, the ROC tax deferral would become an outright tax break. As you can see, REIT tax benefits are not derived from one single provision, but instead, they all work together to provide a holistic tax advantage solution. For investors seeking to gain exposure to institutional quality real estate while receiving tax advantage distributions, a REIT may be worth consideration. With that, I'd like to hand our discussion over to Abigail Drager, who will discuss tax advantage insurance-based solutions. Abby, over to you.
Thanks, Doug. I'm so pleased to talk with you about insurance-dedicated solutions. After this section, you should have an understanding of how insurance offerings, such as private placement life insurance, or PPLI, and private placement variable annuities, or PPVA, can help individuals achieve tax-advantaged growth in alternative investments. Despite historically tax-inefficient alternative investments, insurance-dedicated solutions can offer clients the potential for tax-advantaged growth. In my section of today's course, I'll focus on private placement life insurance, or PPLI, and private placement variable annuities, or PPVA. PPLI and PPVA, simply put, are variable insurance products that allow individuals to invest in certain assets on a tax-advantaged basis. When properly structured, they allow clients to defer taxes on investment gains held within the policy, and in the case of properly structured and maintained private placement life insurance, potentially eliminate taxes on investment gains at death. This allows for more efficient compounding of investment returns and makes such insurance powerful wealth and estate planning tools. Unlike off-the-shelf retail insurance products, these offerings are private placements, which allows investors to access a wider variety of investments, specifically alternative investments like hedge funds and private market offerings. This is particularly compelling given the historical tax inefficiency of certain alternatives. So, how do these work in practice? There are some key similarities and differences between PPLI and PPVA structures. In each solution, investors contribute premiums using after-tax dollars to fund the vehicle. These premiums are then invested into an underlying portfolio which is managed by a third party, and the gains on those investments grow tax-deferred. A key difference between PPLI and PPVA comes at the end of the policy's life. Private placement life insurance policies provide a death benefit that is left to designated beneficiaries. This death benefit is transferred income tax-free. Additionally, if the policy is owned by an irrevocable life insurance trust, this death benefit may also be estate tax-free. Under private placement variable annuities, there's no life insurance component. While PPVAs typically include a death benefit feature that is equal to the contract value, there's no insurance leverage, and the gains are generally taxable as ordinary income when paid to a beneficiary. However, if the beneficiary is a qualified charity or foundation, the gains transfer income tax-free. There are some other key differences as well. Because the PPLI structure is an insurance policy, a full medical underwriting is necessary before the policy can be issued, which is not the case for private placement variable annuities. Due to the life insurance component, PPLI structures tend to have higher fees than PPVAs. Additionally, PPLI may offer a layer of asset protection subject to state laws and ownership structures. Assets within a life insurance policy may be shielded from creditors, lawsuits, and other legal claims. Both policies can be very powerful wealth, tax, and estate planning tools, but they are not designed to achieve the same objectives. This makes it crucial for investors to consider their primary goals when determining which insurance solution is potentially a good fit. Both PPLI and PPVA may be suitable for ultra high net worth investors who are interested in gaining exposure to less tax efficient investments such as hedge funds, private equity, and private credit. If the investor's primary goal is to leave a legacy to a child or other family member, or to avoid selling assets to meet estate tax liabilities, the PPLI structure is more likely to be appropriate. If the investor's primary goal is to generate a stream of income later in life, a PPVA may be more suitable. A PPVA may also be suitable for clients with charitable aspirations, since proceeds transfer income tax-free to qualified charitable institutions. They may also be appropriate for investors who currently reside in a high income tax state but plan to move to a lower income tax state in the future. Before walking through a few more details about how the underlying mechanics of these investments work, I think it is worthwhile to walk through a hypothetical example, which can drive home the power of potential efficiencies that can be gained by the tax-deferred nature of these investments. In this example, we'll compare a PPVA structure with a taxable account, and we'll assume a $15 million initial PPVA investment. For illustrative purposes only, this hypothetical example assumes no interim withdrawals and an 8% annual net return. Let's also assume that the annual taxation of gains in the taxable account is at a combined federal and state marginal rate applicable to a Connecticut resident in the highest tax bracket, and that the taxation of the PPVA gains are at ordinary income tax rates upon distribution. Actual results will vary. Now, assuming an 8% net annualized return, the initial $15 million in a taxable account would be worth $20.1 million after 10 years. The investment in the PPVA account would grow tax-deferred to $31.4 million or $23.6 million in after-tax proceeds. The tax-free compounding of investment returns is even more powerful over a longer time horizon. That same $15 million invested for 30 years in a taxable account would grow to $36.2 million. In the PPVA account, the value would be $138.4 million and $79.4 million after tax. Now, let's spend a few minutes discussing the mechanics of these vehicles, including certain IRS requirements that must be met for them to maintain their tax advantage status. We'll also look at what the underlying investments in each of these vehicles look like. To maintain the tax benefits, the structures must meet several regulatory pillars: the diversification test and the investor control test. The IRS requires variable insurance contracts, including PPLI and PPVA, to be properly diversified. The purpose is simple. No policy can behave like a single concentrated investment. Specifically, the portfolio must be diversified across multiple investments. No single investment can exceed 55% of the portfolio, no two investments can exceed 70%, no three can exceed 80%, and no four can exceed 90%. The second crucial rule is the investor control doctrine. While policy owners can choose the overall investment strategy, asset class, or risk profile, they cannot directly control the specific investments inside the policy. Investors can choose among insurance-dedicated funds or insurance-dedicated separate managed accounts designed for PPLI or PPVA. They can also set their risk tolerance and broad investment objectives, replace managers, or change allocations among approved options, and request rebalancing among the available investment strategies. But what they cannot do is select individual securities or portfolio holdings, nor can they direct the timing of trades or provide instructions to the investment manager about specific investments. The idea is that the insurance company must be the owner of the assets. The insurance company is the owner of the underlying assets, while the policyholder is the owner of the insurance contract and the beneficiary of its economic value. Now that we've talked about the diversification and investor control pieces, let's talk about what you actually can invest in through a PPLI or PPVA contract. Specifically, insurance dedicated funds, often called IDFs, and insurance dedicated separate managed accounts. An insurance dedicated fund is a pooled investment vehicle designed specifically for use inside a PPLI or PPVA contract. It's not available to the general public, and it must comply with the insurance diversification and investor control rules that we just discussed. A few key characteristics. Only insurance carriers or qualified insurance dedicated accounts associated with variable insurance contracts can invest. IDFs are managed by third-party investment managers, think hedge funds, private credit firms, private equity sponsors, etc. And IDFs often mirror existing strategies, but they have been structured specifically to satisfy the diversification rules. Essentially, an IDF allows sophisticated managers to offer their strategies in a format that the insurance code recognizes, so that the growth can accumulate tax-deferred or tax-free inside the policy. Insurance dedicated separate managed accounts are for clients who want a more bespoke approach. These look and feel like a customized investment mandate, but they remain fully compliant with regulations to maintain their tax status. Key characteristics of the insurance dedicated separate managed account. Like an IDF, these are managed by a third-party investment manager. But unlike an IDF, they are mandates that are created specifically for the policy and therefore offer the ability to tailor risk-return targets. The manager, not the policyholder, controls the underlying investments used to meet that risk-return target. As with all advanced planning strategies, PPLI and PPVA structures require careful coordination among legal, tax, and investment advisors to ensure compliance with applicable laws and suitability for the client's objectives. I'd now like to return the conversation to Frank for some closing words.
Thank you, Abby. We hope you've enjoyed learning about some of the strategies designed to help investors take a tax-forward approach to alternative investments. Of course, these are not the only ways you can help improve the tax efficiency of client portfolios. However, the alternative strategies and vehicles we covered today can be tailored to achieve the goals and objectives of many investors. Thank you again for your time. We encourage you to continue exploring these and other important topics on the Morgan Stanley Alternatives Investing Center.
All right, folks, I am just taking their exit questionnaire, and then I will be going live
We
again
hope
at
you have enjoyed
12:15
today's class.
with another
As a reminder, you can download your continuing education certificate of
with
completion
another live
from the folder at the
another
bottom of your
training
screen.
today at
If
about
you would like to
12:15.
schedule a conversation to discuss some of the ideas covered in today's class further, please click the meeting request button on your screen. Materials have been made available to download in the documents folder at the bottom of the console. We appreciate your feedback, so please take a moment to answer a brief survey also located on your console. And for additional insights, we invite you to register for upcoming classes at investinginalts.com. Thank you again for joining us, and we hope you have a great rest of your day.
All right. So, ladies and gentlemen, there you have it. It says, this is the type of stuff I'm talking about. If you ain't trying to do it big, you might as well go home. Well, Rael, we understand how that goes with a lot of folks right now. You know, everybody's entertained with Anton Daniels. At any rate, ladies and gentlemen, I'm getting ready to shut down. I'll be going live again in about another 15, 20 minutes with another training. Feel welcome to stop by. You know how I say, Like, subscribe, and as always, share, share, share. And lastly, wipe ass. Work in progress every day and see success. Salute.